Well, welcome everyone. This is a special podcast with yours truly, David Morgan from the morganreport.com. Today, I have Peter Pham with me, and Peter reached out to me years ago, actually, and he's had me on a couple live events with him via the internet, and gotten to know him more over the last several months. And we decided together to put him on the Morgan Report on top of everything else that he has done. So I'm going to ask him to introduce himself, and then I'm going to show you a book that he's written that's on Amazon. We're going to talk about that for a moment, and then we're going to move into what have you done for me recently, the nemesis of the newsletter industry. I don't care how much money I made in the past. What have you done for me lately? And that's one of the main reasons I was fairly intrigued with bringing you on board, is because you have both a short, medium, and long-term outlook. And I'm pretty much long-term buy and hold conservative investor, although we do trades from time to time. So all that said, I'm doing all the talking, Peter. Let me turn over to you. Tell me about yourself, what you do, and how long you've been doing it.
Hi, David. The story, and hello to the audience. The story is that about the year 2000, I was watching the Business News Network in Canada, and I saw you on the interview discussing about, at the time, probably my favorite asset, which was silver. And you inspired me basically to buy as much as I possibly could. I was still, I think at that time, I don't want to age myself, but at that time I was still working as an intern. I was doing an intern job as a data analyst, actually, in Canada, which is kind of different. I feel fortunate to do so because most people, as their first jobs, would be at the movie theater, which probably has its own benefits, which is the popcorn. But the great news is that got me exposed to a little bit of numbers and analytics. And then subsequently, I've basically utilized my interest in investing, having been hit in the dot-com crash as well, because I was told that a lot of mining companies were going to turn into tech companies in the time. But the thing that saved me was actually buying a lot of silver based on your recommendation, and what Buffett was doing with his portfolio. So it's very exciting at that time to see, like, when you don't know anything from a perspective of stocks and mining companies switching to tech, you don't know what you're doing. You're just chasing the crowd and the momentum. And then there was this thing that was potentially called like a sound investment, where I was listening to what people like yourself was saying about the potential intrinsic value relative to the market price, and starting to get exposed to all sorts of different ratios and analytics. So if I was starting that around like the year 2000 at that time, and we're at the year basically like 2024, so imagine if one was to do that driven by passion, but trying to find pragmatic avenues to think about how to utilize that information and knowledge. So it subsequently led me on to studying information systems and human behavior, which was a multidisciplinary major in a university in Toronto, called the University of Guelph, actually. Truthfully, the reason why I picked that one was that it had a really high woman to guy ratio, because it was a little bit agricultural based. So it was a 7-to-1 ratio, and you get that statistic in your university manual. So again, trying to apply statistics, and we'll explain more about that after. But it's kind of interesting. If you're going to be stuck in the dorm, at least you'd be surrounded by, I guess, girls from all over Canada, basically. So, but in the meantime, you got to study a lot of great statistical courses, and you got to study the humanities. And interesting enough, if you think about it, computer science in conjunction with understanding human psychology really works well for that of understanding more about the market. Little did I know that would be ultimately what I'd be doing in the year 2024. But I think it all kind of meshed well together. So after that, I did a little bit of further investing, working a little bit in Toronto. Then I moved over to Asia. I worked for a big investment bank, also called Macquarie Bank. And I worked for a few like asset management companies. And then around 2012, I published a book because I had actually started applying this this methodology, which we'll speak about more later. And then I noticed that I was achieving a lot of success in it. And then subsequently, I decided to kind of venture off on my own to basically invest in basically large caps, small caps, small to medium enterprises, and private equity as well to build like a portfolio. And then after I noticed that, hey, I was kind of doing pretty good. And I believe that we started to speak around 2016 again. And then around the last 7 months, I decided to move out of Asia and then go back, well, not go back here, but go to North America. And I decided that if you're half as good as you might think you are, and you got the energy to do so, why not shoot your shot in Wall Street? So basically, here I am in New York City and trying to cause a lot of disruptive. I want to be like kind of like disruptive entity to try to hopefully provide a lot of value from a perspective of independent research, or from a perspective of newsletters, from a perspective of analytics, from a perspective of investing. So I feel like all of that has worked out quite nice. And then I decided that if I'm going to be here, I might as well both do super short-term trading, which is proprietary trading, and then long-term investing. And then also, if you're going to come up with all these ideas and spend all your time doing that, why not also add some more scale to it? Because if you're already doing a journal, you might as well share that to everyone. And then I subsequently reached out to you and said, hey, David, I'd love to be able to share my research as well. And then somehow I managed to convince you, and here we are, basically.
Very good. All right, so I've got, can you see the screen?
Yeah.
Okay, so
Wow.
I brought up the Amazon. It's your book, Big Trade, Simple Strategies for Maximum Market Returns.
Right.
And as you can see here, which is kind of humorous, the used version is only over $2,000. I laugh because who knows, you may get that, or Amazon will get that. You'll get some small portion. When my book, The Silver Manifesto, I left Amazon, and the highest price I know of was about $250. In fact, I met the gentleman that bought the book off of Amazon for that price at an investment conference. But back to you, a powerful, profitable, and elegantly simple system for traders. We don't need you to read the book to us, but if you just kind of give us an overview, how popular was it, and why do you think there were, let's say, very high-end type traders and hedge fund managers that gravitated to this book, and how did they find out about it?
Yeah, a great question. I think that basically I wanted to write, having, like I said, in the year 2000, gone through like all the content that was available in investing. I wanted to find basically the most effective way. And I know that people get very dogmatic about this because everyone wants to defend their turf or their school of thought. But I really wanted to find a way that didn't really require like that much, how would you say, like either like luck or that much time. Like, if you make a long-term investment, hopefully at some point in time, it's going to work for you. So I noticed that, and I've been sharing this recently, and this will be featured, by the way, in my next write-up. I believe I came up with the title today. I think I'm going to call it something like Asymmetric Market Warfare, which will be featured on your the Morgan report, the premium one. And what I've come to realize is that, and I was sharing to you last time, is that markets are probabilistic. Very similar to a few things that we have in our society, which is like if one was to go to the casino, they would identify that most of the games there are probabilistic. Even if it's a high probability, it's still ultimately probabilistic. It's not deterministic. Interestingly enough, games like chess are considered deterministic because you get to see all the information on the board. There's no variable that you're not aware of. And because you know all the rules, in theory, it could play by itself, meaning you don't even need any kind of like outside factor. So if you notice, like there's a lot of events that happen. Let's even take something like the Trump assassination attempt, is that he'll cite that, perhaps it was God that protected him through this unprobabilistic events in which basically the bullet just skimmed the ear, for example. Many people attributes things like some kind of like deity when it refers to something that is very low probability. And I think what an astute speculator or trader or even basically a professional gambler, by the way, that they should be using statistics to understand the world. And I was just watching one of my favorite movies. It's called Rounders. It has Matt Damon in it. And it's about a poker player that wants to participate in the World Series of Poker. And he meets his mentor and his teacher. And his mentor and his teacher is very boring. He's not taking like high, big bets. He's not going for like something super dramatic. In fact, he highlights the fact that being a good poker player is about the grind. You know, like you're trying to go for safe bets. You're not trying to go for everything. And you're more than happy to make a little bit on the P&L every day. It's not glamorous. It's not what you will see on TikTok. I call them crypto bros. You're not going to see crypto bros that are going to be posting like flashy jewelry and stuff like that based on their crypto success, nor are you expected to be like kind of like what the day traders would be, where they're posting crazy P&Ls and stuff like that. But everyone knows that the statistics of being a good trader or investor is actually in the realm of trading. We're talking about like what, like at most maybe 1% could actually make a living doing
it's
that.
About 1%, believe it or not.
Yeah.
You and I know because we've been there, but you know, you get sorry to interrupt. I'll just go add to this. Then there's of course the crutch. You know, I got a computer, so you buy some, you know, trading software, and I have some. In fact, I was beta testing one that was only available on the Mac, believe it or not, way back when, you know, the PC just started. Most people didn't know what a personal computer meant even. But
Right.
coming back to you, but the idea being that you know, it's tough. And I've watched people that do it. I've watched one of the best day trading schools. I was invited there to speak, and they do a great job. But to me, it was I wouldn't say it was boring. It was like having to play a video game, and I'm not a gamer. I felt it was more work than I wanted to handle for the daily grind. You know, to me, it was a job. It was a job staring at a screen, looking green, red. Okay, out of momentum. Okay, the volume's good. Hit. You know, to me, it was like a computer game, and you almost could be mindless about it. But you got to sit there pressing buttons all day. Sorry, I'm going to take a lot of your time, but it is something that most people don't realize the details of it. It sounds good. I work for myself. You know, I'm going to make this much money. You know, all this stuff. But when you get down to it and do it, it's not as glamorous. That's my take. You can add to that. And the last thing I'd like to say is that's why after I lost one, I finally had to get a trading method that worked for me. You have to get your personality involved. And I've just positioned trade from then on. And almost all of my position trades, and many of them are spreads, just do really well. But you got to be patient. You got to be you know, you got to also admit when you're wrong and quickly admit when you're wrong. You know, take that loss again and again and again. The thing about trading, especially in leveraged markets, so you could take 10 small losses in a row as long as you've got the discipline and one win. And that one win makes up for the 10 losses times 5 because you made 500% on your big trade. And that's what most people think about, but they don't have the discipline to do it. By the time they've taken their 8th loss, they're out, they've given up. It's too hard, and on and on. So again, let me give it back. But you kind of sparked that button because been there, done that, learned the hard way, which I think most of you best traders do. I don't think there's too many that sit there and, you know, get a great software program and whatever, unless they learn at one of these schools and they just do the green-red trip thing and just press buttons all day and come out with, you know, a profit almost every day. And that's fine to me. It's hugely... It'd be the worst job I can imagine for myself.
Yeah. Everything you said completely resonates, and it should resonate to the audience. Like, I think people, the misnomer is the very fact that it's so easy to click buy or sell makes people think that it's a low barrier. Well, because it's a low barrier of entry. But the thing is, the true barrier is being able to do it consistently through scale and to be able to have, like you said, the appropriate like risk management, and then hopefully have a system that understands the win rate relative to the risk management. So it's not as easy as you think. And I think I've been sharing to you this idea of what I call like big finance, and entire and then we'll get back to the book, is that the entire like basically finance industrial complex is all about collecting fees and basically scaring people off to let them know that number one, it really is risky, and therefore one should focus on long-term investing, and therefore one should basically primarily be allocated into your retirement account. But your retirement account is then ultimately managed by these big institutions in which they're collecting the fees, and the entire like tax system incentivizes you to do so because the short-term capital gains tax is already high, right? So the government's getting a fee, the broker is getting the fee, and then on top of that, you actually got to still get some kind of outlier level of return to beat all of that. But that outlier return that you're forced to achieve pushes you to take basically outsized risk, and therefore that's why so many different people lose. And therefore, that's why even those people that one would see online that are promoting about their success, arguably you could make that case that maybe some of them have either had some kind of short-term like lucky streak, or for some reason they're being fraudulent about that. And that's one of the unfortunate things about the financial service space too, is because if one cannot show a way for individuals to generate income that in theory could rival that of, let's say, having a 9-to-5 job, and if you're supposed to be long-term from a perspective of investing, which truly does bring you good returns, but it requires time. And in the same time, you still need to basically pay the bills, keep yourself fed and stuff like that. So if you take that equation out, then what happens is that the investor might have their retirement account, but then they're forced to still think about, hey, what am I going to buy as even a swing trade? And then the question is how they assess the opportunity. So they could be going for a hot stock tip, for example, or they could be watching the media, like some guy that's saying about a drug that's going to get approved by the FDA. Like that story, basically, I've heard that so many different times where someone hears that about that opportunity and they take a little bit of their spec money and they lose it on that trade as well. So when you break it down about the opportunities that truly exist within capital markets for an individual, you should see how stacked the deck really is against you, and then understand and appreciate that, and then try to find an approach and methodology that allows you to eke out some kind of success in some capacity. So I'll give you an example, is that so many different people are like asking me, oh, what do you think you'll earn this year? And I would never dare to kind of say that, David, but I can tell you something. For many people that are doing short-term trading, if they're attempting to basically get even like 1% a day, they're more than likely to blow up, because it implies that they're utilizing too much leverage relative to their capital. And imagine if you're wrong, right? So then if you're wrong, and you're wrong, let's say even 50% of the time, then suddenly at 1%, that starts to compound too. And the reality is very few people are able to find something with a very good hit rate. So going back to the book, was I wanted to discuss about all of those principles. I wanted to highlight how many approaches in investing are very ad hoc. For example, if I was to draw a bunch of like, let's say, trend lines and something like that, I might draw it a certain way. You might draw it a different way. It really is almost about like interpretation. And then let's say if you decided to use a daily chart and I decided to do, I don't know, a weekly chart or a monthly chart, then suddenly we're getting different signals. And what I preach in the book is basically using probabilities and statistics with a foundation that works across all time frames, which doesn't require one to make adjustments on the indicator, irrespective of the time frame that is being shifted at. So it shows you that there's some rigor and some robustness to the approach. And I've had the opportunity to learn from some great minds in investing. A gentleman, his name is Victor Niederhofer. He was a trader for Soros, actually, and then he also traded for Jim Rogers. Because you want to identify who's the guy at the trading desk for these guys, right? These guys might have the great ideas, but clearly their trading and execution must be good. And he stressed to me about the scientific method. And he stressed to me that if you're going to develop a system or approach, you should run it through the scientific method. You should run it through statistical analysis and tests to see if your approach is what we call statistically significant. And if your approach is not statistically significant, then it's more ad hoc than it is more of a science. So I try to highlight some of that in the book because I feel like even people should not misconstrue speculation. We were talking about the analogy of a gambler. A gambler is a gambler, but there's different kinds of gamblers, right? We talked about the professional, that's sort of a grinder. And then we talked about the gambler that loses his shirt. And when you study poker players, blackjack players, guys that are at the horse track, there are guys that consistently win, and while everyone else is losing. And the commonality amongst all of them, David, is actually statistics and probabilities. In blackjack, it's counting the cards. In poker, it's understanding, I think it's called optimal game theory, where if you watch the World Series of Poker, you'll see the probability of the person winning because the TV, one of the features of watching it on TV is you get to see everyone's hands and they show you the statistics and probabilities. This idea was also introduced in the movie Moneyball, where even sports teams are trying to lever off statistics to try to find an advantage in winning. And it's had such a big effect. I understand that there's some arguments about it. It's not the be all and end all, but actually, if I was to rely on exclusively one tool, I would rely on that. And I try to demonstrate that on like the content that I write. As you know, like even within the Morgan report, I'll write up a great like macro piece, or it's up to the audience to decide if it's great. I'll write up a very compelling, a well thought out piece about what I see happening in the long term. And I'll give some great swing trades based on how they performed. But I think that if I was stuck on an island and I had nothing, I think that I would rely on statistics and probabilities, and that allows one to be basically a minimalist. And then if you have a great idea, and we can talk about maybe later, or maybe I'll do it now. So basically the last 2 days or the last 3 days, the market has been tanking relative to being at all-time highs. And it's been led by the technology sector. And what was interesting is while we were asleep, interestingly enough, there was like basically a global, I guess, like meltdown in terms of cybersecurity, in which so many different computers were off. So you had already the excess in technology stocks, and then overnight you got to see the failure of tech companies, which then almost ensured the probability of us closing down for Friday. And when you think about the fact that you had the setup of the previous 2 days leading up to today, and the fact that Friday or Monday tends to be the low of the week from a seasonality perspective, it created a great opportunity for one to, number one, think about their risk management and understand, wow, I got a 92% chance that the market's going to tank effectively right after the open. And if it went up a little bit, that was a great opportunity to short. And I as you know, last night I was sharing that to you as well. I was like, hey, this is what I'm thinking. And when those opportunities come, then you know that's when you can, I hate to use the word, but you can bet big. And what I mean by that is from a risk management standpoint, there are some days or some investments or some trades, you can put a few more chips on the table. Some days you maybe want to use less. So going back to the book is, I see it's almost near the price of gold, and perhaps it's worth its weight in gold. And I try to show that real time, basically, to the audience, and we can talk more about that after.
Great. I want to interject something from my personal life, but my dad, somehow or other, was one of the first people to buy the Thorpe method of card counting. I wasn't even of age. That's how long ago it was. And so we bought the material and studied the heck out of it and went in and gambled. And the best is, of course, one-on-one, because you have no nausea with somebody who doesn't know, card counting was brand new. but they didn't know the basics of blackjack. They didn't know the probability. They didn't know, if the dealer's on the 17 or higher, you have to draw the 17.
Right.
And all the basics. So the point is this, that as you count the cards and the deck goes from, neutral to favorable to very favorable, you go from 1 unit to 2 units to 3 units.
Bingo.
And I just wanted to compound what you just said. And that's the same thing with investing. And that's why I'm so strict about, what we do on the speculative side of the portfolio. This is money you can afford to lose. And when do you press that bet? It's when there's a material change in the company. Everything that they said they're going to do, they did. They made a discovery. Their drug got approved. They merged with somebody and have an asset that, whatever. And it's hard because, you don't want to be a patient person on a speculation. You want to, get buying the rumor, selling the news, 2 weeks go by, you're done. And sometimes it happens, not in my letter very much, although we've had some, instant successes. They're very rare. But I just wanted to bring that up because it's like, well, wait a minute. And I just want to bring back the gaming analogy and the statistical probability. If you know that deck has got a bunch of 10s in there left and the deck's halfway down, your chances of getting a 20 are pretty high.
Yeah.
And so instead of making a meager bet, you're going to triple your bet, which is the limit. There's rules. So you put it out that $300 instead of 100, and then you get a 20. And now you count the deck, and it's very favorable. You'd like to go to 4, but you won't. You're disciplined. You put out 3, and you hit a 20 again. So I don't want to belabor the point, but I think it's important for us to discuss this because there's this idea, unfortunately, especially in the gold sector, because I've been in it for so long, that you're really making great investments if you buy a bunch of junior mining companies. Well, first of all junior mining companies are not mining companies. They are exploration companies. They're not mining. If they're mining, they'd be, but the word mining's in their name, and a lot of people don't know that drilling means that you're exploring. They think that drilling means you're drilling out the ore body, and you're, in some cases in exploration, you're drilling into an ore body. But the point being is that part of the process isn't taking ore out of the ground, bringing it to the surface and selling it. It's mere exploration. So I'll give it back to you. I want to emphasize that a little more and then move on to the Substack if you're ready.
Yeah. Because I know that a lot of your audience has exposure to mining companies, I'd love to give them almost like a model of thought that allows them to deal with all the things that they're experiencing. So when I originally said that markets are probabilistic, what our audience should be aware of is that if you're looking for catalysts and drivers within the fundamentals of the company, investors and traders should be aware that there are only moments in time in which those catalysts and drivers truly have an effect on the price. So let's say it's a listed company, a small cap company, and the argument is that small cap company is undervalued, and agreed. And it's probably undervalued for so many different reasons. One of the arguments is, let's say, underexposure or something like that. Let's take that, right? So I'm sure a lot of the people in your audience have this company that probably fits that kind of case study. And what I'm here to say is that, so the daily gyrations of the stock or the daily sideways nature of the stock, if one notices, has nothing to do with how someone understands the fundamentals of the company. For example, they got so-and-so reserves of gold, and therefore their NAV could be worth way more than its current market capitalization. What the heck is happening? And, why is it so cheap and why is it not correlating? I experienced that too, David. And that's why what I want to say is that you have to understand that there's certain days in which fundamentals are super important to the company. For example, earnings, right? So earnings and earning calls, you'll notice that there's a lot of volatility around the stock. And hopefully if the news is good, then you'll start to see the stock really ramp up. And yes, I agree that there's sometimes what's called a positive earnings drift that can really push the company. But hypothetically, let's say the subsequent week, we have a global crash, for example. Perhaps the stock's going to go down, even though there was some great news that came out a week ago. And what I'm trying to express to the audience is I'm saying that think of it like a race, okay? So there's so many different variables about why a stock is going up or down at this very minute, this very tick, this very day, this very week, this very month. And what you have to understand is that certain days, there's certain factors that are taking the lead on why that stock's going up or down. So when you write in the ticker symbol and you see all the news wires on it, it's always something different, right? It could be like, oh, so-and-so corporate announcement. Oh, today the sector's down because of so-and-so issue, for example. And you'll notice that it's actually quite random and it takes actually different leadership throughout the time. I'd love to share to the audience that even the whole argument of there's more buyers and sellers, it has validity, but actually the weight of the argument of more buyers and sellers equals to 50% causality of why the stock price is what it is, let's say today. Meaning, let's say we saw a spike in volume. I was watching Trump stock recently, and a few days ago, after the assassination on Sunday, basically on Monday, the whole idea was why not buy Donald Trump stock because that's a great way to support him. So on that subsequent day, you saw 75 million in volume, the stock went up like 30%. The following day, with substantially less volume, the stock then declines 10%. And what I conducted was a study several days out to see how the stock would perform after you had a true causality, which is more buyers and sellers manifested through a 75 million in volume on that day. So what I'm saying to the audience again is that different days, different elements, be it corporate actions, be it volume, be it something more macro, something more focused on the sector, they all take different leadership. And the only issue is that let's say you got a great factor or two. Let's say you think the company is cheap. Great. So maybe on quarterly earnings, it's going to start to gradually manifest itself. So the thing that people are not aware of is that even if you have this great value idea and value thesis, you're still benefiting from the fact that the stock market overall has gone up 60,000% in the last 100 years. There's basically a positive drift to it, which is kind of different from commodities. Commodities in themselves don't necessarily have that positive drift to that propensity like that of the stock market. But in similarity, there's certain factors and variables that will impact the stock. So let's say if a great value investor, let's take Warren Buffett, let's say if he says, hey, I think Coke is cheap, right, he might be right. And I would attribute 30% of his valuation argument to be the causality of why Coke went up from a few 100% from the year 1980 up to the year, let's say 2010. But it doesn't explain everything because at that time, you had a market that went up as well. You had stimulus, you had, booms and busts that were eased out through more money printing effectively. So there's so many different variables. Coke became more of a global company as well. So you had so many different factors. And he individually cannot take credit for that, even though he identified that there was a value play. There were so many other factors. And the issue is this, is if you think about the investing community, they always talk about different things, right? Like you're going to have to worry about the technicals. You're going to have to worry about the fundamentals. You're going to want to diversify as well. And the reason why we have all of those things that we need to do is basically to ensure that we're not going to get screwed over if this quarter is not good or this year is not good for us, because our thesis only could represent maybe 30% or 40% to explain why price is the way that it is. And I guess the final point is that if one really is a great valuer, one will experience more success in the investment banking space, the private equity space, because you're not then interacting with the stock market. If you believe that the company is cheap, you can do some M&A transaction, and it could be a private transaction, and you could get full realization of your valuation argument through some kind of M&A transaction that's not related to the listed market. So when I interact with a lot of investment bankers, even they themselves, when they look at the gyrations in the market, they're kind of like, I don't know what's going on, because they can't explain it themselves. and then they just focus on their spreadsheets, which is fine. So that's why when I say that the stock market, the listed stock market is basically probabilistic, there is so much significance to understanding that. So therefore, it can allow you to understand why things are the way that they are. And it truly, I'm trying to be as understanding for the viewer as possible, which is if I'm opening up Globe Investor, I don't even know if that site still exists anymore, or if I'm opening up Yahoo Finance and I'm seeing all these random pieces of news to explain why my stock moved, I'll never get the full answer. And that's why I'm saying that markets are probabilistic. They take factors and variables, take the lead at different times in any period of time that you want to slice and dice.
All right, let's go ahead and, if you don't mind, move on to your Substack. You should be looking at that now, right?
Yeah.
Okay, and of course, it's got your name at the top here. Now, I just used it as a search so you could see all these articles that are in your Substack. And
right.
It's called Inversion Investor, and you have both a free and paid service. Is that right?
Yeah, just put up the paid service and increase the price 3 times today, actually. So just because I realized that, like, I mean, this day and age, being able to trade and invest is actually becoming accessible for everyone. So if someone could actually provide you calls that really worked out really good on a relatively consistent basis, and I hope that you can also attest to that because your audience probably knows you much more than they know me, is that when you realize that you have a pretty good batting average, and that by the way, I'd like to express that all the calls here, I actually put my money where my mouth is. That's the most important thing. I treat it more like of a trading journal, just to chronicle the idea that I'm ultimately taking anyways. And then I'm just scaling all that IP by just ultimately sharing it to the audience via call. I think the difference between me and many other people is, yes, like there's elements of education, but I've always heard this what's that great commentary about educators is like, educators aren't really good practitioners. And I feel like I'm not really if you want to learn, I'm happy to teach, but I'm not selling any kind of like course or anything like that. I'm just basically making a call. I'll share it to the audience and I'll convey a lot of the methodology behind it. And if you observe over a period of time, you'll find more often than not that I'm right, basically. And ditto for even the swing trades or the investments that some of your premium subscribers have been receiving since I started to appear in your publication. In fact, the only company, all of them are up. Only one company is down because of today, which is CrowdStrike. But actually, CrowdStrike had built a pretty good buffer zone since the coverage that I provided on the month of May. But everything else, we talked about it too. It was like mentioning JP Morgan. I don't think that's ever appeared on the Morgan report. And I kind of explained the rationale. And since then, it's been up quite a bit, even for this month. So going back to the Substack, it's called Inversion Investor, off of Charlie Munger. I do some video presentations on the website as well. And he said, always invert, basically. And I thought that was like, we kind of live in an upside down world where it's so hard to explain things in our world. So I feel like by thinking about things in an inverted manner, it's a great mental model to take. And hopefully you'll be able to find what's upside down and try to exploit it. And that allows one almost to be a contrarian as well. That's another way to convey a word of inverting. So you can see here, based on the site, right there where your mouse is basically, I write short. Oh, it's paid. That's when I put up the paid wall. Then I basically increased the price like twice today, basically, because of inflationary pressures, to be in line with inflationary pressures. But if one had shorted basically in the morning, I think you can see the chart right there. You would have done extremely well, basically. And I made the call right there. You can see, David, is that you'll get it by 12 o'clock. I tell the audience, you would have received the email at 9:35 a.m. Eastern. You got the call of a 90, which indicates that I'll probably be 93% right on this. And I also indicated that you'll get your exit by 12 o'clock. And subsequently, the market was very low at 12 and 11, and it made the low of the day around like 120, basically. So that's the kind of value that you get. So I think I highlighted that one futures contract to get about like 30 points on the S&P could equate to that of 1,600. So simply by taking that one position, you would have got your subscription's worth in only a few hours, basically. But I think the more important thing is that if you find some good calls, that implies scale. And I've been doing this for I don't know how long since we've been speaking. Basically, I was telling you about my methodology, and I try to send it to you without being annoying because I know you're very busy too. But I try to basically make these calls all the time.
Well, you do make quite a few, but not so many. You can't keep track of them.
Yeah.
And as you said, your track records that you've been associated with the Morgan Report have been pretty stellar, almost all winners. So that's really great. How much interest have you got from Substack? Is it just a big ocean and there's so many places to go, or is it pretty refined on the financial side and people find you pretty easily?
So I think like you before as well is like I used like so as I told you, I think my book was published in 2012, and then after that, I was doing like a lot of media and stuff like that. Um, I feel like obviously the media wants particular kinds of narratives, as we can see over the last like few years. And I suspect that when someone is being very candid and stuff like that, that's certainly not the narratives that they want to hear anymore. So then suddenly what happens is you get pushed into some more niche categories. But I think what's important and what should be important to the retail audience is that basically it's better to, I think, things that are not popular in this day and age are things like the truth. And then another thing that's not popular then is, well, in my case, or if you're making investment calls, for example, is to be right. And you'll see that I don't think the financial or big finance or the finance industrial complex is very interested in people being right more often than they're not. Because that wouldn't really work if everyone was right. That's not how the system is supposed to work. And to be right in the short term, think about a guy that wins the Powerball, right? He's taxed like crazy, number one. And then number two is that it's supposed to be very low probability that he even wins to begin with. So I don't think our society is very big on people that identify things that are relatively quick, that seem to work, and do allow you some kind of substantial capital gain, from the tax system to education to big finance to everything. And the great news is all the evidence is supportive of frowning upon that, because basically most people are losers. And because they're not willing to use things like the scientific method and to like grind it out and find an edge. I wrote this recently, David, is like, think about all the brokers. They give you all the tools you want for free, right? And I use the analogy that casinos also give you a lot of alcohol for free as long as you're just playing and you're hitting the slot machines, because they know at the end of the day, the house always wins. So clearly, whatever indicator that you're using, if it's free, perhaps it's too good to be true. And therefore, that's what I was experiencing. And I felt like, wow, like if I have to create my own kind of school of thought to ensure a greater success rate, then so be it. And I want to take all the variables of me overthinking out of it, and I just want to, let the numbers speak for themselves, basically. So long story short is that I trade all of that, so then I can do pretty good financially through trading that, and then by just sharing it, it's sort of like an afterthought, to be honest with you. So I'm not like, I rather have like long story short is like the list amongst like the 7,000 people is a lot of big institutions, endowment funds, some of the biggest fund managers you've heard of on Wall Street, and some high net worth individuals. And part of our partnership as well is to exposing it to your big audience as well. I don't think I didn't spend that time to curate the audience, but I feel like if you have a great project or product, then perhaps you can team up with some people to add some more scale to what you're doing.
Very good. Well, if people want more information, what do they do to get a hold of you? I'm sure you're not that hard to find.
Yeah, I mean, I think they could just sign up on Substack, or I guess they could subscribe also to the Morgan Report as well and get some of my stuff. And I'm sure you guys also have like a support email, and they can probably find me on Substack. I think is probably the best route, and hopefully we'll end up doing more podcasts and video casts and stuff like that, and participate more. So I think those are probably the two best ways for everyone.
Very good. Next time we speak, I want to talk about the options market and how I learned that the hard way. And there is such an advantage. It's almost like a tilted pool table. But
Yeah.
and I learned it early, but we'll talk about that next time. Anything else you'd like to say before we close out?
Yeah. Well, just two cents about the options market is that perhaps that's one of those tools that allow investors the ability to secure their gains while trying to ensure that they're holding a longer term position, as opposed to basically selling out at a capital gain less than a year and being in the tax regime of a short term capital gain versus a long term capital gain. So options are super powerful if you know how to use them and if you know how to think of them. I've even heard of something which I've never dabbled with in the speculative community about binary options. I suspect I know what it is, which is basically like either you're right or you're wrong. And I think that whenever there's an interesting product or a new product in the financial service space, think about how one could actually do well in it. And that mental exercise perhaps also makes one a better investor and trader. So, options have time expirations, warrants have time expiration. Try to think about things in the realm of the 40, the time element as well, and see how you could use that to your advantage, as opposed to kind of like, so the whole idea about buy and hold is basically to say, hey, I take no responsibility for what will happen in time, basically. But if you want to get better, I think you should identify all the speculative products that exist and try to figure out how one would be good at it, or perhaps they'll subscribe to some of our products and services and get some more ideas to improve their own approach, basically.
Very good, Peter. Well, it's been a lot of fun speaking with you. We will have to do it again, and make a great weekend.
Thank you very much. And thank you, everyone, for listening in, and hopefully they got some value from it.